Hello friends, welcome back to my channel Quest for Knowledge. Today we are going to discuss international banking and forex management. So here we are going to discuss all 5 type of papers, 2 model papers and 3 previous year question papers, so that we are going to go through with overall 2 marks, 5 marks, 6 marks and 14 marks. So anyhow we are going to get thorough so that you can get good score in your semester. So let's get started. The first question is, what is international banking? International banking is just like any other banking service, but it takes place across different nations, which is in an international manner. So put it another way, international banking is an arrangement of financial service by a residential bank of one country to the resident of another country. So these are all the benefits. Going to write is, international banking is the same banking service but doing it in an international way from one country to the another country. Benefits are flexibility, accessibility, international transactions and account maintenance. International payment system represent different way of payment and settlement of claims and commitments between the subject from different country. So international payment system, it is the different way of payment and settling all the claims and the commitments, and which is completely from one country to the another country. So that is the international payment system. Now after that, what we have is the volatile capital flow. So volatile capital flow is nothing but the movement of money for the purpose of investment, trade or business production. So this type of capital flow are done within the corporation or in the form of investment capital and capital spending on operation, on research and developments. So that is the volatile capital flow. We have the next question, which is, what is the meaning of asset and liability management? Asset and liability management is the process of managing the use of asset and cash flows to reduce the firm risk of loss from not paying the liability on time. So well managed asset and liability increases more business profit. So that is why asset and liability has to be managed. What is flexible exchange rate? When the exchange rate is being determined by the mechanism of demand and supply. So every currency area must decide what type of exchange rate arrangement is to maintain. So it is like there are certain fixed and there are certain managed exchange rate, but the flexible exchange rate depends on the demand and supply of the currency. What do you mean by convertibility? Convertibility is the ease where we can exchange one country's currency, which can be converted into gold or any other country's currency. So that kind of a exchanges is possible. So that is called as convertibility. Even Indian rupee is called as partially convertible. Why? Because rupee can be exchanged at market rates, in gold also, in some other currencies also. But we need permission for the larger amounts. Export finance is a process of funding the exporters to facilitate their business in the global market. In simple word, it is a cash flow solution for exporters and to cater the production and other kind of transactions globally, which needs working capital. So it is a process of funding for the exporters to expand their business in the global market, is export finance. Now we'll move on to section B. The question is, discuss the various overseas investment finance program. Exim Bank encourages Indian company to invest abroad. So this is overseas investment finance program. First is the Exim Bank specially, and the other international banks also offers the overseas investment finance. So here they set up manufacturing units, and then overseas investments are possible with the help of IPR, and loans are being given up to 80% on the equity investments. Indian companies get loan extended to overseas, term loans to overseas. Capital expenditure towards acquisition of asset. They finance for the working capital. They provide equity investment in another company. eligible for finance facility to the overseas for raising term loans and working capital. Let's move on to the next question, which is discuss the capital flow and exchange rate management. Exchange rate management, it is to stay consistent with the achievement of the inflation target. Inflation is the rising of the currency value. Perform exchange rate intervention to reduce short term volatility. So, short term fluctuation, to reduce that one, they perform exchange rate intervention. They find the optimal balance between the providing room for appreciation, depreciation, and manage the adequacy of the foreign exchange reserves. Meanwhile, capital flow management is to utilize the macroprudential, it means the overall sensitivity. The overall sensitivity instrument to manage capital flow and prevent external sector risk, to promote financial deepening of the foreign exchange market, and to support the management of foreign exchange reserve as a form of self insurance. Next question is, what are the advantages of offshore banking? The advantages of offshore banking is that it has reduced cost, it is time bounded, and it will increase the confidence of the customer, and we can easily access to from various countries. We can easily acquire, and then currency avoiding currency control in your home country, hindering business efficiency. After that, currency, and then client confidence, credibility. If we get the access of the quality banking, so a client from Eastern Europe prefer global business account in Germany for reputation, and then the risk is completely diversified. Discuss the need for the stable foreign exchange rate. A fixed exchange rate, sometimes called as a pegged exchange rate, as it is a type of a rate where country value is fixed against the value of the other country's currency. So, in the value of gold also they will make it fixed. So, that is, it is why it is called as the fixed exchange rate. And the government always maintains the official exchange rate, and they set price. In this, always the government intervenes into this. Okay, there are various benefits and even the risk for the usages of the fixed exchange rate, as it is really used in order to bring the balance of the value of the currency by directly fixing a value which is a predetermined value, not the different one like a flexible one. Okay, objectives of foreign exchange control. The objective of the foreign exchange control is to conserve the foreign exchange, to maintain the balance of payment, to maintain the value of exchange, to prevent a flight of capital, okay, which is inflation, to protect domestic country, and to encourage essential imports. So that is the objective. What are the prerequisite for capital account convertibility? What is capital account convertibility? So, capital account convertibility means the freedom to convert our currency to the other currency of the country. But our country, India, allows only partial convertibility. So, today we are going to discuss what are the advantages of this kind of convertibility. Okay, like if you want to convert your currency to the other currency of the country, which is not possible because RBI will not allow. RBI will allow to a limit, but not to the full of the limit. Why? Because it is not free convertibility. India goes with the partial convertibility. Okay, so we'll discuss the benefits of the cash flow convertibility today. So this is the benefits of the capital account convertibility, which is availability of large fund to supplement domestic resources, and it will surely promote economic growth, and will have international financial market, and the cost of capital will reduce, and it will be an incentive for Indians to acquire and hold international assets, and it will be a complete improvement in the financial system because of the global competition. The other perquisite of the currency of the capital flow convertibility is that it will give more encouragement to export, and it will increase the profitability, and we will try to encourage import substitution. We will try to find out domestic alternative to stop or to do the import as less as possible, and will have send remittances from abroad, it means discounts, self balancing mechanism as per the balance of payment. It will be specialization with more comparative advantages there when compared to the limitation, and it will create a world economy. It will be a linkage of the local economy with the world economy. So these all are the perquisite of the capital account convertibility. Now we'll discuss what are the various types of exchange rates available. So what are the various exchange rates? So exchange rate means domestic country have to pay to obtain a unit, okay, of foreign currency. Okay, we need to keep some of the amount as reserve to get some foreign currency. So that is exchange rate. So there are various types of exchange rate. First is the fixed rate. It is also called as the pegged or the linked to another currency of asset. Example, they always take gold as to derive the value. Okay, they take gold, and as per the gold they fix the rate. Okay, and flexible rate is it will completely depend on the mechanism of the demand and supply of the currency. When the demand of the currency increases, then the value of the currency increases, lead to the currency value also gets increases. So that is considered as the flexible rate. Flexible rate is as per the value of the demand of the currency and the supply of the currency. After that we have forward rate. Forward rate means they will purchase the currency for the future trade. Forward means it is futuristic one. So it is, the rate is predetermined for the sum of the date of the in the future. Spot is the immediate exchange. It is the day to day exchange rate, which is called as spot rate. And dual rate, it is of two value, one rate applicable for foreign transaction and one for the domestic one. Okay, after that, currency exchange quotes are there, direct and indirect quotes, bid and ask rate, cross currency rate. Cross currency rate is that India and American dollar want to exchange, so they will go and take the values of euros. Okay, so when they have the same kind of a gold, as per the gold, they will go with the crisscross currency rate. Bid and ask, first they will bid, and then the highest money they will ask for the rate. So HSBC Bank, which headquarters in London, and HSBC Holding, it is publicly owned bank and sixth largest public bank. Okay, and it is credited to have. It is also said that it had first ATM in India because of the HSBC Bank. Second is the Standard Chartered Bank. It is initiated in Africa. The Standard Bank got merged with the Chartered Bank of India during the year 1969. After that we have Citibank, which is 109 years old Citibank and one of the oldest foreign bank in India. Its headquarters is in Kolkata, West Bengal, and it has the financial service of $4 billion capital commitment in onshore and banking and other financial services, and it has 42 branches across the 40 cities of India along with 700 ATMs. After that we have the Royal Bank of Scotland. It is the bank's history in India goes back to 1921 and it has 31 branches across the country. And we have Deutsche Bank, which is initiated in 1980 and it has 16 branches operating in 15 states across the country. And DBS Bank, which is previously known as Development Bank of Singapore. The DBS Bank was started by the government of Singapore in June and it has 12 branches in India within cities like Chennai, Kolkata, Bangalore, Mumbai, Kolhapur, Nasik, Kadalur, Moradabad, and it has 37.5% stakes in DBS Cholamandalam. Barclay Bank, there is no branches in India. Number of branches is 10. and it includes 9 lakh clients, okay, and who belong to multinational companies. PNB Paribas, which has number of branches in India, 8, and according to Forbes and Bloomberg in 2012, it is the third largest bank. After that, we have Credit Agricole Corporate and Investment Bank. It has number of branches, which is 6, and it also works in number of cities in the India, and it has 58 countries including India, where they deal with all kind of banking investment. Okay, the Credit Agricole CIB has clients mainly from corporate, government, and investor segment, and it leads with the project finance, acquisition finance, export, etc. And Bank of America, which has number of branches in India, 5. Bank of America started functioning in India from Mumbai branch in 1964. So that is why the headquarters is in Mumbai, and 5 branch offices across Mumbai, New Delhi, Kolkata, Chennai and Bangalore it's operating. And Bank of America is the biggest bank holding company in the United States. International capital flow are based on the portfolio investment, which is not the part of FDI, and other investment which are short term one, and the foreign direct investment, which is FDI. So portfolio investment comes under the equity, debt, securities, bond, debentures, and money market instruments like treasury bills, and financial derivatives like options and sell. Okay, so that all comes under the portfolio investment, which the international capital flows, which is from country to countries. Second is the other investment, which is short term, completely short term liquidity funds, like taking credits, loans from the financial trade and mortgages, financial leases, currency, and depositing. So that all comes under the other investment, which is short term one. Portfolio investment is a long term one actually. And the foreign direct investment, it's equity capital we are investing and earning, and from intercompany debt transition, that all comes under the FDI. Through this, the international capital flow. Details about the marketing advisory service of Exim Bank. So the marketing advisory is being provided by the Export Import Bank to help Indians or the any country for the exporting firms to represent themselves in a global manner. They want to assist and locate overseas distributor, buyer, partner for their product or services, to identify opportunity overseas for setting up plans or project for acquisition of overseas company. Exim Bank has successfully placed a range of product in overseas as well as domestic market, like handmade paper, handicraft, vegetables, fresh fruits, etc. So this is all possible because the Mass Group also organizes workshops and support events to facilitate design and package their product for the international market. Okay, making your product to be prepared to be designed in such a way to be represented in the international market. So this is are the key roles of the market advisory services which is provided by the Exim Bank. Who all are eligible to get the advices from the Exim Bank is that the Exim Bank offers market advisory services across all the sector. Any company or firm which is not identified in the negative list of Indian foreign trade policy or international convention is eligible to avail of the service. So the requirement from the company should be the company profile, product brochure, printed material, prices, existing export market and target market. Need to disclose the way your company or your firm is performing in the export trading, and as per that the Exim Bank will provide you advice, okay, so that you can present your product in more desirable way to attract the foreign customers. So export finance is the process of funding the exporter to facilitate their business in the global market. So in simple word, there is a cash flow solution for the exporter is being provided, so that is export finance. So international capital market, it provides the forums and mechanism for government, company, the people to borrow or invest across the national boundaries, which is in an international manner. So it is to invest, it is to deposit. So it allows the government, people, companies, firms to invest, deposit or borrow loans. So that is considered as international capital market. It deals with the fund across the boundaries of the nation. So offshore center is like a country or a jurisdiction which provide financial service to non-resident on a scale that it commensurate with the size and the financing of its domestic economy. So being Indian, when you are getting the loan from any of the European bank, so that kind of a thing is considered as European offshore centers. So balance sheet is nothing but the summary of your financial balances. It shows the balance of your liabilities and the balance of your asset. It can be of anyone. It can be of an individual, organization, an organization of also of any type, sole or partnership or a private or a public limited company or a government or a non-profit, anything. Okay, but it is the balance of your finance, like balance of your assets and liabilities, that summary is considered as balance sheet. So foreign exchange in short term it is called as Forex. The conversion of one currency to the other currency is called as the foreign exchange. In a free economy, a country's currency is valued according to the law of supply and demand. So currency value can be pegged, which can be fixed, or it can be fluctuating one, or it can be a managed one. So when you convert the currency of one country to the other one, it is considered as foreign exchange. The role of foreign banks in India, it enhances the competition in the banking sector, technology and skill transfer. Both foreign and local bank have been investing on financial innovation, leads for the modern banking services, enhances the customer satisfaction, and it enhances the provision of foreign currency to the corporation. Foreign bank participation in foreign exchange and money market contribute, it completely strengthens the financial system. As every bank, okay, faces the liquidity risk, so it is the current and the prospective risk. So that is why ALM functions, deals with the liquidity risk, it deals with the interest rate risk. Why? Because there is a movement in interest rate and it will impact on the future cash flow. So that is why they always go through. Why? Because interest rate is just fixed, variable rates are there in the balance sheet, so there should not be any kind of a mismatch between the assets and liability, so that they will always keep a check on the interest rates risk. And last is the currency risk management. Why? Because risk of losses resulting to movement in exchange rates also, and it is very volatile and very risky. So that is why they keep on maintaining all of this risk. Last is that it also deals with the credit risk. Okay, for the loans which is being given, like cash, investment and loans. So ALM is that asset should have to get balanced with the liability. Sometimes there is a mismatch between the asset and liability, especially for the banking, especially in the banking one. So that the main ALM function is to maintain and check on all of these various risks. The various type of issue is public issue, initial public offer which is called as the IPO, further public offer which is also called as FPO, offer for sale, of issue of Indian depository receipt. So these all are the different types of issue under the primary market. So these are the various type of risk in finance: credit risk, market risk, and non-financial risk is the operational risk, strategic risk, funding risk, political risk, and legal risk. So financial risk is the borrower risk, okay, industry risk, like the portfolio where we have invested, that risk, market risk, interest rate risk. Why? Because interest is completely volatile. Liquidity rate risk, whether we are able to easily turn it into cash, that risk is there. Foreign exchange, anytime it can lead to any kind of devaluation. Which is the hedging risk, which is hedging means it's like a insuring, so that you should not face any kind of risk. When there is no hedging, it will also lead to a kind of risk again.